I'm Danni Hewson, Head of Financial Analysis at AJ Bell, and I'm joined by James Flintoft, Head of Investment Solutions at AJ Bell. We're going to dig into the AJ Bell Funds and Management Portfolio Service, how they performed since the start of 2024, and unpack a little bit about how we expect they might perform through the rest of the year. James, thanks very much for joining us. Let's start with markets because they've performed really strongly since the start of the year. What have been the main driving forces?
Well, markets have got a sense that global growth is improving, particularly in areas like Europe, China and the UK. If we think about the UK, we've obviously just had a small recession, and now the focus is shifting to this reacceleration phase of the economic cycle. That's obviously assuming we get a normal economic cycle. Global equity markets have been led by Japan and the US actually. In Japan, there's a real sense of change there. International investors have been picking up that there may be a catalyst on the horizon and increasing their allocations. And that centers around the change in inflation dynamics in the country. We've seen the first meaningful change in inflation and wage growth for over 30 years, which is quite something if you think about how that market has operated for the last 30 years. On top of that, there's a real corporate governance drive to improve how companies operate and the efficiency of their balance sheets. That's nothing new. That actually came in after the election in 2012 with the launch of Abenomics, but that has really captured the imagination again. If we look at the US market, that's been a touch broader this quarter. The Magnificent Seven have still been a factor with individual companies making a significant contribution to the market, but some have fallen by the wayside, and sectors such as energy and financials have performed well, and they tend to be more cyclical in nature. The energy sector is obviously following the oil price higher. If we think about the UK market, that's lagged behind, despite some positive trends in terms of sector biases. It is smaller in terms of its constituents, the size of those companies in there, and that's been a headwind for the market. And generally international investors aren't allocating to the UK as they once were. So to emerging markets and China and India. Those markets have performed well and it's been a positive start to the year, but they've lagged behind their US and Japanese counterparts. Looking in fixed income markets, global government bonds have faced an uphill struggle because there's been a change in interest rate expectations. We've now gone from expecting 6 interest rate cuts from the Fed this year to just 3, and that first cut has been pushed out to the summer rather than the spring. Inflation's also been volatile, so government bonds haven't enjoyed that. Over in corporate bonds, it's been a touch better. Credit spreads have tightened, and they tend to be shorter maturity bonds, so they've not been as sensitive to interest rate changes over the quarter. So investment grade's done okay, and high yield's done particularly well, partly because of its high starting yield.
You were talking about both inflation and interest rates there, both dominating market sentiment still. Do you think they're proving too much of a distraction?
Possibly. That's really centred around fixed income markets and how they're behaving at the minute. In some senses, this is really a return to the pre-financial crisis norm. Wider market volatility has been low at the minute, but actually the front end of the yield curve is proving particularly volatile, and investors are starting to grapple with that conundrum for the first time in over a decade. So it's not necessarily it's an unusual to have these headlines around interest rates and inflation. It's just that we've not had to think about it properly for quite some time.
So let's drill down into AJ Bell Funds and MPS. How have they performed over the first quarter?
The portfolios have captured the returns in equity markets pretty well. Of course, the returns could have been better if we had a higher allocation to the US, but that's not really in keeping with our investment process. These funds and portfolios are designed to manage volatility and think about the long-term prospects for markets. The lower risk portfolios weathered the storm in government bonds fairly well. They have a high allocation to cash. That's been good. They also have an allocation to high yield bonds. Although we cut that back in the first quarter, it's still a reasonable allocation, and that's been one of the best performing parts of the bond market in the first quarter. At the higher end of the risk spectrum, the portfolios have more in emerging markets than developed markets, emerging markets have underperformed their developed market peers for some time now. So that's been a detractor over the quarter. So in the middle of the range, where there's more developed market exposure, not quite so much emerging markets, and not as much in the way of government bond exposure, but still some corporate bond exposure, that middle of the range has really been a sweet spot for returns.
So broadly, how are portfolios positioned at this point, and have you made any changes recently?
Well, we repositioned the portfolios in January as part of our strategic asset allocation process. That centres around two areas. So the strategic side, which this year caused some rotation in the equity part of the portfolio, and the tactical side, in which we intervened in the fixed income part of the portfolios. In fixed income, we increased our duration to what we feel is a more neutral level. We increased it to a level that we're exposed to interest rate cuts should they occur this year, but also not too exposed should we get an inflation surprise this year as well. On the credit risk front, we evened out our credit risk in the portfolio. So we cut back some of our allocation to high yield bonds, particularly for the lower risk portfolios, and reallocated that to investment grade. That's because we prefer the better quality of investment grade at this point. Overall, what we've done in the fixed income portfolio is really make sure that it performs as it should do should we get an unexpected event. Obviously that's unpredictable, but we need to be prepared. On the equity side, as I mentioned, that was the strategic side of the process this year. We didn't intervene tactically. That has rotated us out of the US and into Japan and Europe because the process prefers cheaper valuations in these regions. Thinking about this April's rebalance of the portfolios and MPS, we've made one fund selection change, and that's regarding the Jupiter UK Special Situations Fund. We've swapped that out in favour of the Man GLG Income Fund. That's in response to a manager change. Ben Whitmore will be leaving Jupiter this year to set up a different firm. Our research team has high conviction in a similar fund, the Man GLG Income Fund, so we've made that switch. In doing so, we've tried to make sure that the style and factor bias of the portfolio remains unchanged. So we've not upended the portfolio in making that change.
And what about any further changes? Any more you anticipate?
Well, we have a high threshold for intervening in the portfolios tactically. We've just had that strategic asset allocation project complete in January, and we don't feel that the market dynamics have changed significantly since then. So we're not anticipating making any changes at this time. As I said, with that high threshold, we need to see a significant change in market dynamics. We do stand ready to change the portfolios if needed, but at the moment, we're pretty comfortable with how things are positioned at an asset allocation level.
James, thank you so much for joining us. We look forward to catching up with you and the rest of the team throughout the year.
Thanks, Danni. My pleasure.